Inside any major financial institution, you'll find two incredibly powerful but fundamentally different engines running at full steam. One of them is basically the bedrock of the market. It's all about providing stability and liquidity. The other, well, that's a high-stakes hunt for pure profit. Today, we're going to pull back the curtain and really demystify these two worlds: market making versus proprietary trading.
So here's the central puzzle we need to solve. How can one desk at a bank be designed to make millions of dollars by earning just pennies on countless trades, while another desk, maybe just a few feet away, is risking millions of the firm's own money on a single big idea? You've got one business built on volume and another built on conviction. They really do seem like polar opposites, but they exist in the same building. By the end of our time here, you'll understand exactly how that's possible, and, more importantly, why they are kept strictly separate.
You know, it all boils down to two essential needs that any healthy market has. First, you need liquidity providers. Their business is all about immediacy, making sure anyone can buy or sell an asset right now without waiting. Then you have the capital deployers. Their business is the hunt for alpha, which is just a fancy way of saying profits that come from being smarter than the market, from finding assets that are mispriced. These two roles, these are the very DNA of the two trading desks we're talking about.
So here's our game plan. We're going to start with market making, the engine of liquidity. Then we'll pivot over to proprietary trading, the profit-seeking arm. After that, we'll get into something absolutely critical, the guardrails that institutions put in place to manage all this risk. And finally, we'll put the two models right next to each other to make the differences crystal clear.
All right, let's dive into market making. And I want you to think about this less as speculation and more as a service. It's a foundational role in any modern financial market. The easiest way to think of a market maker is like a currency exchange booth at an airport, but for stocks and bonds. They're always there, always willing to both buy from you and sell to you. For instance, on the NSE, a market maker might offer to buy a stock for, say, 3,450.00, that's the bid, and at the same time offer to sell it for 3,450.05, that's the ask. That tiny 5 paisa gap between the two, that's the famous bid-ask spread, and that's how they get paid for the service of being available 24/7.
But that spread isn't just free money. Not at all. It's really compensation for taking on three very specific risks. The first is inventory risk, the simple danger of buying a stock and having its price fall before you can sell it to someone else. The second, and this one is so important, is adverse selection risk. This is the constant fear that the person you're trading with knows something you don't. Imagine an insider trying to offload shares right before bad news hits. The spread is a market maker's insurance against being the last one to find out. And finally, of course, it just covers their basic operational costs. Now, this shows you the market maker's playbook in real time. Look at that top row, neutral equilibrium. The market is calm, the bid-ask spread is super tight. But now, look what happens when they have excess long inventory, meaning they've bought too much stock and are holding more than they want. They immediately widen that spread, mostly by lowering their bid price. Why? To discourage more people from selling to them. It's just like a grocery store putting ripe bananas on sale to clear them out. And in a real crisis, like you see in those bottom rows, they might just pull their bids entirely to stop the financial bleeding. It is a constant, live-fire exercise in risk management.
So here is the absolute key takeaway from market making. They do not want to bet on whether a stock will go up or down. Their entire goal is to end the day as flat as possible, with no position. Their profit comes from capturing that tiny bid-ask spread millions of times over, not from one big, correct bet on direction. It's a high-volume, low-margin business of pure facilitation. Okay, let's shift gears completely and look at the other side of the firm, proprietary trading. If market making is about serving the market, prop trading is all about trying to beat it.
This is the polar opposite of market making. Here, the firm is taking its own money, its own capital from the balance sheet, and intentionally taking large strategic positions. The goal here is absolutely not to be neutral. The goal is to be right. They are actively searching for market inefficiencies or betting on future price movements to generate really substantial profits.
And their toolkit is incredibly diverse. It can range from strategies that are considered relatively conservative, like merger arbitrage, where you're betting that a publicly announced corporate merger will actually go through, all the way to highly quantitative stuff like statistical arbitrage, which uses complex models to find temporary glitches in historical price relationships. Then you get into the pure conviction plays. Directional trading, which is a straight-up bet that something will go up or down, and volatility trading, which is a fascinating bet not on price direction, but on how much the market is going to swing around.
Now, when you have profit engines this powerful, you're also dealing with immense risk.
So the big question is, how do institutions keep these desks from blowing up the entire firm? That brings us to the all-important guardrails, risk management. The risk models for these two desks, well, they couldn't be more different. Take a look at the value at risk, or VAR limits. You can think of VAR as a simple statistical measure of the maximum amount of money a desk could lose on any given day. For a market maker, that VAR limit is incredibly tight, and it's measured daily. They are on a very short leash. A prop trader, on the other hand, their VAR limit is much, much larger, and it's measured over a longer period, maybe 10 days. And that's by design. It gives their big, strategic bets room to breathe, because their core idea might take weeks or even months to play out.
This table does a perfect job of lining up the capital, the risk, and the revenue for each activity. For example, look at equity market making. It uses very little capital, its main risk is just holding inventory it doesn't want, and its revenue is the bid-ask spread. Simple enough? Now compare that to merger arbitrage on the prop side. It requires a massive amount of capital, its core risk is that the deal falls apart, and the profit comes from the stock prices eventually converging when the deal closes. You see? Each model is its own self-contained ecosystem, perfectly tailored to its unique goal. All right, let's bring it all home now and put these two models directly side by side for one final, clear comparison.
This table really is the whole story in one picture. On one side, you've got market making. Its objective, market facilitation. Its use of capital, minimal. Its primary risk, inventory. And its revenue, high-volume spreads. Then you look at proprietary trading. The objective is pure profit generation. Capital isn't a cost, it's the weapon. The risk is being flat out wrong on a big bet, and the revenue comes from that high conviction. So we're not just talking about two different strategies here. These are two completely different business models, operating under one corporate roof.
So at this point, you're probably thinking, okay, I get it, they're different beasts. But why does this distinction matter so much to regulators, to the people who actually write the rules for the entire financial system?
It matters because one is seen as absolutely essential, while the other is seen as a potential source of systemic risk. In the US, the Volcker rule pretty much allows market making to continue, but it slammed the door on most speculative prop trading at big banks. Here in India, SEBI is putting in place stricter rules for the clear separation of these desks. And globally, you have regulations like Basel III, which effectively makes speculative prop trading much more expensive for banks to engage in by requiring them to hold more capital against it. The incentive is clearly to prioritize market stability.
And this quote just nails the regulatory point of view. Market making is viewed as essential infrastructure, almost like the plumbing of the financial system. It has to work. Proprietary trading, on the other hand, is seen as a private, speculative hunt for profit that, if it goes wrong, could endanger the whole system.
So if you remember just one thing from all this, let it be this. Market making is a high-volume, low-margin liquidity business. It's all about facilitation. Proprietary trading is a high-conviction, high-risk capital business. It's all about speculation. One serves the market, the other bets on it.
And I'll leave you with a final thought to chew on. Now that you understand these two distinct structures, just imagine for a moment what a sudden violent market crash would do to each of these desks. For one, it would be a terrifying crisis of inventory and out-of-control volatility. For the other, it could mean either a catastrophic loss or the opportunity of a lifetime. Their experiences of the same event would be profoundly different, and thinking through why is the next step in really understanding the market's inner workings.